Hello, everybody. Thank you very much for logging on today. This is Ilian Yotov, and I'd like to welcome you aboard to our first quarter of 2010 review of the Forex market. I am the foreign exchange strategist at allthingsforex.com. To a lot of you, perhaps, I am also familiar as the creator of the quarters theory method. It's been gaining popularity in the last few years. And my book, The Quarters Theory, was recently released in January of this year. It is called The Quarters Theory, The Revolutionary New Foreign Currencies Trading Method. It was published by publishers John Wiley & Sons. It came out in January of 2010. Of course, you can find more information about me and my book on my website, allthingsforex.com. Once again, the address is www.allthingsforex.com. I'm the founder of that website, as well as tradertape.com. It's a website for trading and investing videos. If you're one of those traders who likes to publish videos, you're more than welcome to go to tradertape.com. We provide you a platform where you can actually upload your own videos and share it with other traders as well. I'm also the host of the popular daily All Things Forex broadcast, and every day, Monday through Friday, you can actually listen to my live analysis of the foreign exchange markets. We cover foreign exchange developments, major currencies, economic data, and also outlook on major currencies as well. Now, today what we're going to do is take a look at some of the trends that have been developing in the first quarter of 2010 for the major currency pairs. And then we're going to switch over. We'll take a look at some of the major currencies such as the dollar, euro, British pound, Japanese yen. If we have some time, because of the delays obviously, we may not have enough time to take a look at the commodity currencies as well today. But in general, we're going to do a bit of an overview of what has happened here in the first quarter of 2010, and just a couple of days from now, we're going to start the second quarter of 2010, so we'll see if we can get some sort of an outlook as far as whether these trends for the major currencies would have a good probability to continue even further into the new quarter. As we go along the way with this presentation, feel free to email or write some of your questions. So we're going to have a questions and answers session as well along the way. I think we have about 40 minutes, so let's go ahead and get started. And we're going to, of course, in the bearish majority of 2009, equities found the bottom after that horrible credit crisis sell-off and risk aversion that has taken a lot of majors lower versus the US dollar throughout 2008 and in the first couple of months of 2009. Of course, in 2009, we have seen equities finding a bottom, investor sentiment began improving on signs of economic recovery, perhaps the worst is behind us, and it seemed like the bearish US dollar, bullish US dollar trend that was lasting before that was reversed in a month between March and November of 2009. So for about 8 months last year, we had a strong rally of a lot of major currencies against the US dollar. But what's interesting to note is that in the first quarter of 2010, it looked like the bearish US dollar trend that lasted for the majority of 2009 has come to a halt. What were some of the fundamental factors impacting the US dollar trend in the first quarter of 2010? Some of them, of course, have spilled from the final quarter of 2009, the fourth quarter of 2009, into the first quarter of 2010. Remember, around Thanksgiving holiday weekend here in the United States, we had news from Dubai, and the Dubai debt crisis actually unveiled at that time, late November of 2009. That was the time, in my opinion, which marked the beginning of the end of that 8-month bullish trend for a lot of major currencies such as the euro, the British pound, and other higher yielding currencies versus the US dollar. And that also marked the beginning of signs of US dollar strength after the Dubai debt crisis news hit the news wires in late November of 2009. What we also started seeing towards the end of 2009, in the final quarters, third and fourth quarter of 2009, we saw the gross domestic product report out of the United States showing that the U.S. economy was finally returning to growth in the third quarter of 2009, something that other major economies failed to do. For example, if you recall, the United Kingdom's gross domestic product was expected to show the UK economy returning to growth in the third quarter of 2009, but a lot of market participants were clearly disappointed at that time. We didn't see that happen. The U.S. economy grew in the third quarter of 2009, returned to growth, and it was also growing faster than anticipated in the fourth quarter of 2009 as well. We started also seeing toward the end of the fourth quarter of 2009 and beginning of the first quarter of 2010, we started seeing improvements in U.S. economic data. Gross domestic product, as I mentioned earlier, was improving. We started seeing the non-farm payroll reports, which are non-farm payrolls and employment situation reports, one of the most important gauges of U.S. economic health and conditions. We started seeing the U.S. economy still losing jobs, but not as many jobs as during the huge crisis that we saw in 2008, beginning of 2009. As a matter of fact, later on this week, we're also going to have the non-farm payrolls report, which is expected for the first time in almost a couple of years, since late 2007, for the first time the U.S. economy to start actually adding jobs rather than losing them. Some analysts are now expecting the non-farm payrolls report on Friday to show the U.S. economy adding as much as 180 to up to 200,000 new jobs, which would be more than likely a positive outcome of the non-farm payrolls report. So obviously the U.S. economic data started showing signs of improvement. Perhaps many of you would remember the non-farm payrolls report for December of 2009, and the market's reaction to that report was, normally throughout 2009 we're actually witnessed how better economic data has caused equities to trade higher, markets around the world to be higher, and then along with that, we have seen increase in risk appetite, which has been negative for the U.S. dollar offices. Traders have been looking for investments into higher yielding currencies. But what we started to see also toward the end of 2009 and the first quarter of 2010, we started seeing another development. Good economic data actually beginning to be supportive for the U.S. dollar rather than being negative for the U.S. dollar. On top of that, after the Dubai debt crisis started in November of 2009, we also started in a month after that to see the Greek debt drama, as I like to call it, unveiling. And that obviously has shaken investors' confidence, and it has accelerated risk aversion, which also began to help the U.S. dollar as well. What we have seen for the euro, and throughout the beginning of this year, we started not only a new year, but also a new decade. In a previous decade, the euro has been the main currency that has been perceived as the main alternative for currency reserves diversification. The euro has enjoyed a multi-year bullish trend for the majority, multi-year bullish trend against the U.S. dollar for the majority of the last decade. As we know, a lot of the reasons as to why that has happened is the diversification amongst reserve managers around the world, looking for alternatives to the U.S. dollar, and of course, the second best alternative to the U.S. dollar, or the first rather best alternative to the U.S. dollar, was the euro. The backbone of euro strength has also been the fiscal prudence of European nations, and especially the larger economies there, especially Germany, which is the largest economy in the Eurozone. But with the Greek debt crisis, and also not only problems revealing themselves in Greece, but also in other southern European nations, debt-ridden nations, so to say, the euro stability and integrity has become in question, especially in the last few months. I want to show you the longer term chart of the euro, and this is very simple charts, by the way. Buying, selling pressure charts resemble simple moving average. You're going to see these months. This is a monthly chart of the euro against the US dollar. And before we follow up with that, let me quickly just go to the room here. I'm going to have to switch over and see if you guys have any questions. Okay, so it looks like everything is working fine on my end. If you guys can hear me okay, just let me know. If you can't, email or write down, and I'm going to make sure that everything's working properly. So let's go back to the slides here. And this is the long-term chart of the euro against the US dollar going back to 2008. What you can see is that this is the period there in late February, beginning of March of 2009, when the euro finally found the bottom, and we started seeing the euro enjoying a nice rally for about 8 months. It has managed to move from lows that were around $100.23 to recent high in November of 2009, which was at $51.44. After that high was reached, and all of these debt crises began unveiling, we started seeing the euro coming under serious pressure against the US dollar. Obviously, this is an attempt from the market to reverse that positive trend that has been lasting for the last 8 months, and the euro until now has been pretty much declining against the US dollar for, let's see here, about 2-3 months, consecutive months. Now, what we've also witnessed is, okay, let's see here. And that, what we've also seen is a very strong downward trend establishing for the euro against the US dollar on the midterm side of things. A lot of traders would agree that the weekly charts are usually the ones we would consider as the indication of a midterm trend developments. Here is again that high at the $51.44 that we reached in late November of 2009, after which the euro began a very strong bearish trend sequence. What I call in my quarters theory these trend waves, of course, those of you who are familiar with the Elliott wave theory, classic Elliott wave theory, would probably recall that this is a sequence of several bearish waves. Instead of me going and actually I numbered the Elliott waves a little bit different in my quarters theory, and the reason for that is to simplify the count, because that is the main problem that a lot of traders experience is the wave count. Proper wave count is very crucial for traders to be able to realize what stage of the trend development they actually want to get involved in. So what I do, instead of considering this wave number 1, 2, 3, 4, and then 5, these waves here that give you the price correction, I actually consider as an actual correction rather than being a trend wave. My reason for that is because they don't progress the trend, they actually regress it. Therefore, I don't consider them to be an actual trend wave, but rather a correction following a trend wave. So if we have to call this correction number 1, following bearish trend wave number 1, this is going to be bearish trend wave number 2. This would be correction after the bearish trend wave 2, correction number 2. And then we have bearish trend wave number 3 here in the last couple of weeks that has started once again for the euro against the US dollar. Having said that, there is obvious trend that is being established for the euro against the US dollar, which is still, in my opinion, a strong bearish midterm trend, which is happening within that longer term monthly developments of the euro being under pressure for the last few months. Now, obviously, in order for that trend to reverse, we're first going to have to see this trend line. If we were to connect these highs, obviously, we're going to have to see that trend line being broken. And especially previous highs, recent highs that were a little bit above $1.38. You might actually recall that the euro-dollar pair recently reached a couple of weeks ago a high at $1.3817 or so. And that's going to be the first number that has to be broken above, in my opinion, in order for the euro-dollar pair to actually discontinue, or at least make an attempt to reverse that previously established bearish trend. That also is not only going to be an attempt to reverse that previously established strong midterm bearish trend for the euro against the US dollar, but also is going to give us perhaps an opportunity to see the euro retracing or correcting some of its significant losses that it has recently registered against the US dollar. After all, the euro has dropped since late November's high at $1.5144 to the recent low at $1.3267. And that's a very significant decline. How many pips is that? It's about 1,900 pips, isn't it? Give or take. So if that previous high is broken above, and that's approximately the $1.38 level, $1.3817, we also had another resistance on a short-term side of things at the $1.3839. If these resistances are broken, then we could see the euro actually being capable of producing a larger price correction. But at least at this point, we are not seeing these levels being broken. And obviously that's not the case. Let me see here. I'm getting a little distracted because I'm trying to read some of your questions. Bill is asking, what are your moving average settings? And that's, I was expecting that question because the software bill is actually a little bit different. It does look like moving averages, but what you're seeing here is buying and selling pressure charts. And I will tell you exactly what the formula is for that program. Give me just 1 second here. Let me just expand the screen. The two lines that you're seeing, they do resemble moving averages. And if you get some simple moving average settings, you're probably going to get similar, the charts to look in a similar fashion to this. But what this chart also includes in this software is it also considers not only price changes, but also weighs them against volume. So it gives you every uptick, every downtick for every time period, the highs, open, close, low, and puts them all together and then calculates them against volume. And it gives you a X plus Y and X minus Y formula, which represents these green and red lines. So we call them buying and selling pressure charts rather than just simple moving averages. It's a little bit different, but simple moving averages will probably give that. Obviously, a faster and a slower moving average is what you can set it up with. Now, I'd like to switch you over really quickly to the actual live software program. And let's go ahead and take a look at the euro against the US dollar. I showed you the long and the midterm chart, but now let's go ahead and take a look at the, I'm going to minimize this real quick. Okay, hopefully you're able to see this now with the daily chart of the euro dollar pair. What we're seeing now is the euro actually falling from these recent highs that we had at the $1.3818 or 17, wasn't it? Was the high in recent days. And we've seen again on the daily chart, not only on the midterm chart where we already noticed these 3 consecutive bearish waves, but also on the daily chart of the euro dollar, a couple of bearish waves that have been established. Here's the first one. 1 day of consolidation only, very small little consolidation of price correction following the first one. Breaking below, of course, previous lows here. That's what confirms the first one developing. And then a second one beginning here about 6 trading days ago that has taken the euro-dollar exchange rate to these new lows around $1.3267. Now, those of you familiar with my quarters theory, in my quarters theory methodology, I propose that currency exchange rates do not fluctuate randomly. That currency exchange rate fluctuations occur in an organized manner from one large quarter point targeting another large quarter point. And what is happening with the euro-dollar pair, during these couple of bearish wave, trend wave sequence, we had a completion of this. I divide the 1,000 pip ranges between two major whole numbers. For example, $1.30 and $1.40, where the euro-dollar exchange rate has been for the last couple of months. That's the 1,000 pip range for the euro-dollar pair recently. If you divide that 1,000 pip range into 4 equal parts or 4 large quarters of 250 pips, you would get 4 large quarters that are within each 1,000 pip range. So I propose that currency exchange rates fluctuate from one large quarter point targeting another large quarter point. Now let's go to see what has happened here recently with the euro-dollar pair after it made an attempt to break above that $1.38 level. Here's your high at the $1.38.17. On the way down, the euro-dollar pair produces a bearish trend wave, which is, of course, a bearish technical development, and prices once again fall below the large quarter point at the $1.37.50. Now that we're seeing at that time that the euro-dollar pair is moving lower and it's beginning to work during that first bearish wave on a large quarter below $1.37.50, what could be the next logical price point that the euro-dollar pair could challenge during that first bearish wave? Well, if you use my quarters theory methodology, you would probably more than likely assume that the move is going to target the large quarter point below, given the direction of the bearish trend. During the bearish trend wave, the euro moves from $1.37.50 large quarter point, targeting the large quarter point at the $1.35. And only 2 days after the euro falls below $1.37.50 large quarter point, on March 19, we actually see the euro-dollar pair reaching $1.35.02, which is the intraday low at that point. $1.35.02, of course, only 2 pips above the large quarter point at the $1.35. In the days after that, the euro makes an attempt to break below $1.35, but it actually doesn't enter the large quarter below $1.35 very decisively and goes through a period of a price correction for one trading session after that. After the price correction is over with, once again, we start seeing another bearish wave establishing, and prices begin to drop more decisively below $1.35 large quarter point. Here again, we have a second bearish wave coinciding with another large quarter of 250 pips that currency exchange rates begin to work on once again. What is that large quarter? The one below $1.35, potentially targeting the large quarter point at the $1.32.50. So should it be surprising then to see that on March 25th, 4 days ago, the euro-dollar pair reaches a number which is at the dollar intraday low to $1.32.67. A lot of you who are not familiar with my quarters theory methodology have obviously not, in my opinion, paid very close attention to these large quarter points, and I don't blame you, because the market actually often disguises these major large quarter points. How does it do that? Well, it's a over $3 trillion a day market. It's going to be very difficult for prices to stop exactly at a large quarter point that's being targeted. So in the case of the euro-dollar pair, $1.32.50 was the large quarter point targeted. Previous one was $1.35. In both instances, numbers have been reached that are close to these large quarter points, but the actual large quarter points were disguised. They were not registered as an open, high, low, or close. So what is a trader to do? What I have done with my quarters theory, in order to focus on what's more important, and that is that the fact that the large quarter point is being targeted and it's being reached, realizing that you will, in most instances, not going to see a number of the large quarter point being registered as an open, high, low, or close during any trading session, but rather a number within the vicinity of that large quarter point. I have designated an area of 25 pips, or one small quarter of 25 pips, because when I divide the 1,000 pip ranges into 4 equal parts, or 4 large quarters, you're going to get 4 large quarters of 250 pips. But guess what? the 100 pip ranges between two whole numbers, for example, $1.32 and $1.33, or $1.33 and $1.34, can also be divided into 4 equal parts. When we divide these 100 ranges, we're going to get 4 small quarters of 25 pips each. So I acknowledge that large quarter points in most instances are not going to be registered as an open, high, low, or close on your on these currency exchange rates on a day-to-day basis. And that is why my rule is that if prices reach a number and register an open, high, low, or close that falls within at least 25 pips from the vicinity of a targeted large quarter point, then that is close enough for us to consider a large quarter as successfully completed. So to summarize, with the low at $1.3267 4 days ago, the euro-dollar pair managed successfully to reach that vicinity of 25 pips from the large quarter point at $1.3250, which gives us the successful completion of that quarter below $1.35 to $1.3250 large quarter point. And during that two bearish trend wave sequence, we've seen the euro-dollar pair actually completing these two large quarters below $1.3750 to $1.35, and then below $1.35 to $1.3250. Ladies and gentlemen, $1.3250 was not a support level on a long, midterm, or short-term side of things for the euro-dollar pair. $1.3440 was a support level. $1.3423 was a support level from May or June of 2009 for the euro-dollar pair during that month. But the $1.3250 was not. So a trader who was not familiar with my quarter theory methodology would have not anticipated that $1.3250 might be an actual level that may be targeted, and it could possibly establish itself as a level of support. During the price correction following the second bearish wave, let's see what has happened here as well. During the price correction, prices take off from that 25 pips vicinity from the large quarter point at $1.3250, but because it is a price correction and the euro is bouncing off of these recent lows, the euro makes a move. Can you guess to where? Well, targeting the large quarter point above $1.3250, which is $1.35. Yesterday, the euro-dollar pair completed that large quarter, reaching as high as $1.3505, which I consider 5 pips of an overshoot from the target at large quarter point at $1.35. So this is pretty much what's been happening with the euro-dollar in recent days. Previous high was $1.3568. We made an attempt to approach that level with a high today at $1.3536. We're still about 30 pips below it, and we have seen the euro falling. So that previous high from last week at $1.3568 was not broken, and unless that high is broken, we can still anticipate that there may be another third consecutive bearish wave establishing on the euro-dollar's daily chart. As you can see, we might be in the beginning of that third bearish wave as we speak. If prices continue to remain below that high at $1.3568, we could possibly see the third bearish wave establishing, which could challenge previous lows at $1.3267. And of course, if it breaks below $1.3267, then obviously at that time we can see a confirmation that the bearish trend for the euro-dollar pair on a short and also on the midterm side of things is simply continuing forward. Now, let me go and switch over really quick. Let me know if you guys let me grab this really quickly and go back to my PowerPoint slides. So we can take a look very quickly at the British pound and the Japanese yen, and I have about 10 more minutes to go on this program. So next one, we're going to have another program, if I'm not mistaken, another webinar, which is coming up on Tuesday, April 6th. So on Tuesday, April 6th, make sure to log in then. We're going to review the existing quarter one trend, first quarter of 2010 trends, and then talk about what would be the outlook for the major currencies for the second quarter of 2010. The British pound today is enjoying a little bit more strength on positive economic data, which with two positive reports actually came earlier this morning from the UK. We had the gross domestic product growing a little bit higher than previously estimated, 0.4% instead of 0.3% in a fourth quarter of 2009. And we also have the current balance today, the current account deficit of the United Kingdom narrowing to 1.68 billion pounds from previous reading of 5.9 billion. That was the lowest level for the current account deficit in the UK since the first quarter of 2008. So a couple of good news are helping the British pound today. But in general, for the first quarter and also the final two quarters of 2009, the British pound has been somewhat under pressure against the US dollar. The UK economy, as I mentioned earlier, failed to grow in the third quarter of 2009. Finally managed to return to growth in the fourth quarter of 2009, but it was a very small return to growth, only 0.4% growth. And it's obvious with the US economy growing at 5.6% in the fourth quarter of 2009, it's more than obvious that the US economic recovery is clearly outperforming that of the United Kingdom. Another couple of fundamental factors that kept the British pound under pressure were the Bank of England and its asset purchase program, which has been detrimental to the British pound strength in the second half of 2009 and continued to weigh on the British pound in the first quarter of 2010 until finally in March, if I'm not mistaken, February or March, the Bank of England ended that program, but on the other hand, left the door open for further quantitative easing if necessary. That would be necessary, of course, if the United Kingdom's economic recovery actually relapses in the first quarter of 2010. With the UK economy only growing by a small 0.4%, just barely above 0% in the fourth quarter of 2009, there's obvious dangers that a small pullback could send the UK GDP numbers at flat 0% or even below 0% reading. So there's the risk of UK economic relapse in the first quarter of 2010, coupled with the United Kingdom's elections uncertainty. We're still waiting to hear, perhaps in April, for several days of April. Maybe next week we're going to finally see what the official scheduled date is going to be for the UK elections, hopefully in May sometime, maybe May 6th is what the whisper date is at this point. So elections uncertainty, the so-called hung government in the UK, potential for a hung government because of no clear majority of either one of the parties in the United Kingdom, Conservatives or the currently ruling Labour Party. Over the weekend, in the last few weeks, we have noted how latest elections polls have begun to show smaller and smaller advantage as far as percentage of the vote that the Conservatives are having compared to the Labour Party. So obviously the narrowing there of that advantage is causing more uncertainty about the outcome of the elections. The main concern is that if neither one of these two parties will have a clear majority, then it will be more difficult for them to establish more aggressive budget and spending cuts and more aggressive measures to reduce the United Kingdom's debt. Now, we said that the United Kingdom's economic recovery is actually a very small recovery in fourth quarter of 2009, and a lot of experts at this point agree that we can perhaps continue to see the United Kingdom's economic recovery being rather vulnerable and still fragile and still depending on stimulative monetary and fiscal policies that must be provided by the United Kingdom's government. If that is the case, then the UK government must continue to spend, must continue to stimulate the economy, which could only increase the United Kingdom's debt, which is, by the way, very close to almost 12% of the gross domestic product, very close to Greece's budget deficit, which is about 12.7% of the gross domestic product. So in order for the United Kingdom to have sustained economic growth, it sounds to me like the economy cannot do it on its own just yet. It still may need more government stimulus and spending, which could, in my opinion, continue to keep the British pound vulnerable going forward. The British pound in the last couple of months, of course, has been also under pressure. Inability to break above 2009 highs, which were at $1.7043. They were reached in July of 2009, as many of you would recall, have brought the British pound lower, and recently the pound has fallen below $1.50 level, reaching a low at $1.4777. As I showed you earlier, the weekly chart of the pound-dollar currency pair looks identical to that of the euro against the US dollar. There we can see, once again, a sequence of one bearish trend wave, correction after it, second bearish trend wave, correction, and recently in the last couple of weeks, we're seeing again a third consecutive bearish wave establishing itself on a daily chart of the pound-dollar currency pair. Unless previous highs here are broken above, and they were, if I'm not mistaken, about $1.53 something. Unless these highs are broken, that bearish trend more than likely is going to continue for the pound against the US dollar. And very quickly, in the last few minutes of the presentation today, let me touch on the Japanese yen, which reached a new 14-year high in the final days of 2009. 84.80 was that new 14-year high for the Japanese yen against the US dollar. But the US dollar managed in the days after that and weeks after that to find a bottom and recover some of its losses toward the end of fourth quarter of 2009 and the first quarter of 2010. Obviously, more risk aversion on the Dubai and the Greek debt crisis kept risk appetite suppressed in the fourth quarter of 2009 and into the first quarter of 2010. But the main question now, looking into what may come in the second quarter of 2010, is whether risk sentiment is going to improve in the second quarter of 2010. Now, we have seen the US dollar finding that bottom at 84.80, a little bit below 85 yen, as you can see on the chart. And here, for the last couple of weeks, the US dollar, or I should say 3-4 weeks, the US dollar exchange rate against the Japanese yen has been somewhat contained within a range. I'd like to show you that range really quickly. It is below 93.77 yen, and the recent low is at 88.13 yen. Recently, last week, we had a break above what I consider an interim resistance for within that range at 92.14 yen. And the dollar against the yen is still maintaining above that level. Even in a trading session today after testing it earlier, it has managed to still bounce off of it. What does that mean? That means that the dollar against the yen currency pair, in my opinion, is positioned for the second quarter of 2010 to perhaps challenge the top of the existing range at 93.77 yen. And if that resistance is successfully broken, then that would open the door for further gains of the dollar against the yen. It is not only the dollar that's strategically positioned against the yen, however. It is also a couple of other major currencies, such as the euro and the Australian dollar. Double top resistance is what we are going to see here for the euro against the Japanese yen, which was tested earlier this morning, and the number was reached about 20 pips higher at 125.45. Double top resistance, 125.23 and 125.20 is what the level that's being tested. Will there be a more decisive breakout? If it happens, could that happen in the second quarter of 2010? I think that the first warning signs of a potential impending breakout are already given to us in recent days as we speak. Another currency positioned for a breakout is the Australian dollar against the Japanese yen. We have seen the Aussie strengthening recently, and here is the resistance from 2009 at 86.19 yen. Obviously, there is a potential for a possible breakout there, and I'm sorry that I'm running so late with this presentation because of the technical difficulties that we had earlier. But I'd like to thank you very much for logging on today. Thank you, and all right, thank you. I'm sorry, Maud. I'm running out of time here. I'm trying to cover everything, but let's go ahead and take some questions if you guys have any. I have another minute or two, and I had a list of fundamental reasons as to why now could be the good time to start looking into potential Japanese yen weakness and losses in the second quarter of 2010. But as this lines up with our outlook for the second quarter of 2010, make sure you guys to log on to my next webinar, which is on April 6th. And we're going to talk next week on April 6th at 11 a.m. Eastern Time of the outlook for the major currencies for the second quarter of 2010. For now, I'd like to say once again, thank you all for logging on. I'm sorry about the delay in the beginning of the webinar. I'm looking forward to seeing you again on April 6th at 11 a.m. Eastern Time. Log on for more outlook for the major currencies.